I've saved my clients over $40 million in taxes over the past 3 years, and one of the common strategies we use is setting up an S corporation. But for some investors, this can actually cost you a ton of money, and so in this video, I'll show you exactly when an LLC beats an S corporation when it comes to real estate investing. I'll break down the 3 specific tax nightmares my clients have experienced with S corps and give you my clear decision framework for choosing the right structure for you. Now, some fundamental differences between LLCs and S corps. Most CPAs recommend S corps to save on self-employment tax, but there's a critical detail they miss when it comes to real estate. And why does it matter? We're talking about structural differences, we're talking about tax treatment, we're talking about ownership flexibility and when you can pull money out and when not. And while both entities, the LLC and the S corporation, offer liability protection, their tax treatment creates a massive difference for real estate investors specifically. Now, both the LLC and the S corporation offer pass-through taxation, which means you are going to file a return on your S corporation for your S corporation, and then it flows to you as an individual. When you just have an LLC set up, it stays on your individual, but at the end of the day, they both flow through to your personal tax return. Before I show you why S corps can be terrible for real estate, let's understand why they're so popular for businesses. So most service-based businesses, whether you're an accountant, a lawyer, a doctor, you have a lemonade stand, most service-based businesses can save a ton of money by using S corporations, okay? Just to give you a quick calculation, let's say I'm netting $100,000 in a business, whether it's sole proprietorship, I'm a Schedule C, I'm a real estate agent. Let's say I'm netting $100,000. Well, if I don't have the proper structure, I'm going to pay, not only am I going to pay $14,000 in federal income tax and state taxes, I'm also going to have to pay $15,000 in self-employment tax. So that's Social Security and Medicare tax. Okay, so self-employment equals Social Security and Medicare. It's also called FICA tax. So if you're a W-2 employee, go look at your pay stub and you might see something that says Social Security, SOC, and Medicare, or it might just say FICA tax. And for a self-employed person, that's 15% on your earnings, right? So if you're making $100,000 a year, you're going to pay $15,000 in self-employment tax. So just a quick calculation, instead of paying $15,000 in self-employment tax, I can set up an S corporation. I can pay myself a reasonable W-2 salary from that S corporation, and then the amount that I take instead of salary, but the amount that I take as distributions are not subject to that 15.3%. So in this example, let's say I make $100,000 a year and I don't have the right structure, I'm going to be paying $15,000 in self-employment tax. But if I have the right structure through the S corporation for my service-based business, I can issue myself a W-2, typically 40% of your net income, right? So I issue myself a W-2 for $40,000, and that $60,000 that I take as a distribution, I'm saving 15.3% in taxes on that. And so just for a $100,000 income earner, an S corporation is going to save you $9,000 a year in self-employment tax every single year that you own the business. So if you're a service-based business, if you're a realtor, a property manager, a co-host, a contractor, a lawyer, an attorney, a CPA, a doctor, a dentist, and you are making 6 figures or more and you do not have an S corporation set up, you're costing yourself almost 5 figures a year in taxes. But these same exact benefits become problems when applied to real estate investing, and let's talk about it. Hey, real quick, if you're a real estate investor and you're looking for ways to stay competitive in today's market, I want to help you out. My team and I have worked with real estate investors to save them $10,000 to $50,000 a year in taxes every year, and we currently have a few spots to work one-on-one with us to build your tax strategy. Our average client saves around $18,000 a year by working with us, and if that's something you're interested in, then you can click the first link in the description for more information. Okay, now back to the video. The first disaster I see in S corporations, owners losing massive depreciation deductions. Okay, because unlike an LLC where you're going to be able to get all the deductions and the income to flow to you, when you have an S corporation, there are limits to what you can deduct, especially if you take on debt. Okay, so when you have an S corporation and you own real estate, the borrowing that you do to buy the property, because not all of us have $1 million in cash, I know I certainly don't, and I know I did not have $1 million when I first started in real estate, but when you borrow money to buy properties, and they're inside of an S corporation, you do not get the deduction for having mortgage debt. Okay, so we love debt in real estate field, right? Debt's a tax write-off, we love debt, but when you have an S corporation, you do not get to use the debt. And so if somebody has a rental property inside of an LLC, they're going to be able to use all that debt, all the depreciation as a deduction. When they have a property in an S Corp, however, they are severely limited to the deductions that they're going to be able to get attributable to the debt, right? So we had a client, John, he had put his rental portfolio, before he came to us, he had put them in an S corporation because that is what he got advised previously. And so he was losing out on $37,000 a year for 3 years every year, because had he have had that property owned by an LLC, he would have gotten to take the full deduction. But because he only had it in an S Corp, he was severely limited and he lost $37,000 a year in potential deductions. And so over 3 years, that's over $100,000 in tax deductions that he had missed out on by having improper structure. He had improper structure because he wasn't able to deduct the debt for his S Corp, versus you can if you have a regular LLC. The other example that can really be painstaking is whenever you go to refinance a property, okay? So when you refinance, if you own a property in an LLC or your personal name and you refinance the property, that is not considered a taxable event. Why? Because it's just a refinance, right? That is not a taxable event. However, when you do a refinance inside of an S corporation, they consider that to be a taxable distribution. So here's where it can kick you in the butt, right? If you own a property in an S corp and you're wanting to refinance because the property's gone up in value, okay? So your lender calls you, you're trying to talk to the lender about doing a refinance, and they see that it's in your S corporation. They say, hey Ryan, we can't really do the refinance in your S corporation, but if you had that property in your personal name, we can give you better terms and better rates. So you not knowing any better and you not consulting your CPA, of course, maybe that's because they take 2.5 weeks to get back to you, or they're not real estate focused CPAs, so they don't know the difference. You move that property from your S corp to your personal name, that's a taxable event. That is a taxable event. So if I have a property that, let's say I bought it for $200K, right? And now it's worth $400,000. And I want to refi out. I want to refi that. So I want to, I'm going to go borrow $300,000. I'm going to leave $100K in. I have a taxable event on the difference between what I bought it at, $200K, and what I refinanced at, $400K. That difference is a taxable event in the year that you refinance, right? So you're paying taxes on $200,000. Well, your goal was to refi the property so that way you can take the money and buy it and put it into another property. Imagine if you got this refinance money and you were going to put it into more properties, and then you found out after the fact that you have to pay taxes on $200,000. It's a kick in the butt, and it can be preventable if you have the right structure and the right entity setup, okay? So please be careful. We do not want to own rental real estate inside of S corporations. Anything that appreciates in value, LTRs, STRs, commercial real estate should never, ever, ever, ever be held inside of S corporations. Please listen to this. And if you're somebody whose CPA had you in S corporations all these years, come talk to us and we can help you unravel this mess before you have to pay massive consequences because of taxes. The other con to owning rental real estate inside of an S corporation is S corporations are considered earned income. And because you have an S corporation, you as an officer or an owner of that S corporation are required to take a W-2 salary. But Ryan, I thought rentals were passive income. They are. And remember, passive income is not subject to Social Security and Medicare tax, which is an additional 15% tax. But if you have that rental inside of an S corporation, you are now subjecting yourself to self-employment tax on that income. So the income that was once able to not have to pay self-employment tax and you're able to offset that income with other losses and expenses, you can't offset it anymore and you got to pay self-employment tax. And so it's very important that you do not put rentals inside of S corps because reasons we already talked about. You can't take deductions, you cannot refi out of the S corp without paying a boatload in taxes, and you have to pay self-employment tax on that income that should have been passive. Now, there are some very specific situations where an S corp might make sense for real estate activities, right? If you're in real estate development, if you're fixing and flipping, if you're an agent or broker, if you're a property management company. If you fall into one of these categories, here's how to structure things properly. I'm going to show you exactly what we recommend our high net worth clients who own real estate and are in businesses and how they structure it. For most real estate investors, an LLC taxed as a partnership or a disregarded entity is the optimal structure. So here's how it looks. I'm going to have two sides of my life. I'm going to have an active side, and I'm going to have a passive side. Okay, the passive side that's going to own all my rental real estate properties, I want to have that in single member LLCs or partnership LLCs. Remember, there's no S corporations over here. No corporations. Get that word out of your head. No corporations. It is only single member LLCs or partnership LLCs. And the benefits to this is I get full mortgage basis for depreciation. I have flexible distribution of the property. If I have to refinance or if I have to move money around, it's not a taxable event. I'm able to do a 1031 exchange. I get step up in basis at death. I get charging order protections, state specific, and I get all the benefits to owning rental real estate if I have that optimal structure. On the active side, that's where I want to use my S corporation. My S corporation is going to own any sort of fix and flips. If I'm a property manager, if I'm a realtor, if I'm a broker, if I'm a CPA, a lawyer, the list goes on and on. Any service-based business is going to be owned through an S corporation. But remember, we want to keep S corporations for active activities, and we want to keep LLCs, flow-through entities, for passive activities. And if you can set this up right, you will save yourself tens of thousands of dollars every single year in taxes and unnecessary fees, and you'll prevent yourself from a nightmare when it comes to refinance that property. Hey, if you like this video, you'll definitely like this one. Click that button and I'll see you over there.